Hey everyone, welcome back. Happy Canada Day. It is July 1st, and I should move my sign to red. No, that's going to confuse people, isn't it? It is Canada Day. Your Canadian markets are closed. Look, my sign is red. It's not. We're doing blue today. It's an unusual day to do blue. My name's Levi Woods. This is Drawbridge Finance. This is my Tuesday live stream. So if you guys are interested in stock market investing, options trading, swing trading, day trading, all those types of things, you're in the right place because that's what we're talking about. Obviously not financial advice in any way, shape, or form. This is just what I'm doing, what I'm looking at. So thank you so much for joining me. I see we've got a couple of people online. Let me know where you're watching from. I see Kevin online. He says he can hear me. Thank you so much, Kevin, for always being so diligent and always joining me. MacTech says hello from Munich. Awesome. Love to see that we've got some German viewers. I had a fantastic time the other day. I bought one of those like 5-liter mini kegs of the Munich, what is it, the Helles lager, the little Munich lager. Man, it was tasty. Had that in the sunshine. We're sitting poolside this afternoon for some more margaritas and beer. It's going to be fantastic because one of the things I love about being, kind of self-employed and being able to be a trader, I trade primarily in the morning. That's when I set out my trade alerts. I put them in my Discord. So if you guys are interested in seeing that, seeing the returns, seeing all the posts and trades, head over to the Discord. If you want to be a paid member, you can sign up through patreon.com/drawbridgefinance. Dennis Ziza is watching from New Jersey. Good to see you guys here. And thank you for the likes. I always appreciate it. We're going to get into what is going on in the market. Obviously today, for news related things, big beautiful bill passed the Senate today, so now it's going on to the House of Representatives. This is a American policy basically increasing the US debt over the next 10 years. We don't know if it's going to pass yet or not. It was a very, very close decision in the Senate, and so we don't know whether or not it'll pass or not, but it looks like the stock market is reacting to that. So we're going to get into kind of what is going on in general, and we'll take a look at the market. So SPX flat on the day. You can see where we are with in terms of once Trump got started with all of the tariff stuff, we saw a rather large drawdown earlier this year. We've had recovery. We hit all-time highs on Friday, and then yesterday we were even higher. Today, just the tiniest little pullback on SPX and NQ. So if we're to look at those charts, very, very close. And again, sitting yesterday at all-time highs. Now the Russell, this is the move that the market is excited about. This is the small caps. And we can see from this trend line that I've drawn on here that I'm just going to switch over to an orange arrow for us, but there's this trend line which has been definitely broken. We're past the VWAP, which is this blue line, and we're very much in the center of these Bollinger Bands. And what that means is that especially if this bill gets passed and these small caps start having a little bit more money at their disposal, and if we can get the interest rates down even lower, that is going to be very, very good for small caps, which is what the Russell 2000 is made up of. So these are small cap stocks rather than the large cap stocks that we see in the S&P 500 and the NASDAQ 100. So we're seeing that reflected. It was up over 2% today, sitting currently at up 1.5%. And Dow Jones Industrial Average also, having this bullish momentum, and again, just lagging behind S&P 500 and NQ. So not surprised to see this bullish momentum. VIX sitting very low, 16.65. So this is under the average level. If we were to look at the levels, the volatility index lets us know how much market expectation there is of movement over the next year. And VIX sitting at 16.63 means we're just below the average, which is this red line that we mark on here. Right around that 17, 18 level is kind of the average over time. We saw this volatility in April, obviously very, very high, and we've retracted down, and we're headed into the summer months. What happens in the summer? Typically July, especially the first part of the year, is typically slightly bullish. So if we were to look at a projection as to where things may go with the S&P 500, I would definitely assume that we could have a week and a half, 2 weeks of upward momentum. And when we start to crest on this Bollinger Band, are we going to pull back towards VWAP, towards this point of control? That is a very potentially likely scenario. Another likely scenario is that we could just pull down from here. So are we expecting like massive moves up right now? Not in the S&P, not in the NQ. In Russell, I definitely think we see some upside. So I'm leaning long for my Russell positions, and we'll see how that plays out. US oil trading at $65 a barrel. Obviously, the war in the Middle East over the last 2 weeks has caused oil prices to surge up, but they've pulled back down to this lower level. Point of control around $61. I like to play oil with break-evens around $60. So when it's trading at $65, this is a fine time for me to take long trades where my profit zone is set around that $60 range and above. So that's kind of where I'm looking, and that encompasses the whole Bollinger Band right now. So that's kind of a nice place. Gold continues its upward momentum. We should really draw some lines on here. Let me draw a line on this chart, and just going to draw from the bottom of the candle to across the bottom of the candles, just to show like a basic trend line, and way above its moving averages. You know, gold, all the precious metals continuing to have an upswing, and lots of volume at these levels. So there's lots of purchasing happening, and futures trading. So we're trading very near the point of control, and that's how that's going. So are we going to see upside, continued upside? Potentially. Silver's trading above the Bollinger Bands. I would expect to see a pullback a little bit down from here, but not a huge amount. Into that level, around that $33 level, around this point of control, around $33 an ounce. Big news today, Apple moving up 1.42 today. Sorry, I say big news. There was no big news. We're just looking at what's kind of moving the market in general. So Apple's up, AMD pulling back just slightly after it's had some nice moves to the upside. ARK having a little bit of a pullback as well. Amazon trading at 221, so it's above its VWAP. Looking at Chewy, it's still trading up. This has been a nice trade for Roaring Kitty this year, for those of you who are following him. Hood up 0.2% today. Absolute killer run, expanding into Europe. So we'll see what happens with Hood over the long term. What else do I have in here? MicroStrategy. So this is Bitcoin related. Bitcoin softening a bit right now, so could see some downward momentum here in MicroStrategy. SoFi, little stock that everybody loves to play in the small caps. If you're playing options, playing weekly things, it's a pretty small position to play short puts, covered call positions, or covered strangles. And we've got a position, I don't have a position on right now, but the stock right now is 1768. I would be looking to play this if it came back closer to the 13 or around that VWAP level. And so lots of stocks are in that, overbought territory. What do we have? Tesla breaking under 300 today, gapping down. Definitely Elon and Trump are at each other's throats right now. So we'll see what happens with that. The market trying to digest that news. And from here, I think that these are good neutral plays. How do you trade it though? It's hard. This is a hard stock to play with, both double diagonals and condors. I think the right move for most people is to try to trade this directionally. So when it's in the middle here, you're likely to get chopped out. If we see a move down, up to that lower 200 level, around that 225, which is substantial. These moves are substantial from this current level. Then I might be more interested in taking a directional trade. As always, I'm looking for comments, questions about particular stocks and tickers. So if you guys have anything that you want to talk about, today is the day to ask questions. Let's jump into the chat and you guys can ask me whatever you like. Dennis wants to talk about QUBT. One of the new members of Okanagan Stock Traders is actually trading QUBT on a daily. So let me pull up Seeking Alpha, and we'll take a look at QUBT. Quantum computing, up year to date, 1 year return 43,000%, 4,300%, I should say. I misspoke there. Let's zoom into the year to date. We're up 13% year to date. Quant rating is about as high as you can get on Seeking Alpha. Currently 4.98 out of 5. Wall Street rating it a strong buy, 5 out of 5. So we don't get much better than that. Now profitability is a D, so we have to take that into consideration, but the momentum is obviously good. and the valuation is a B- right now. Now, the short interest here, this is a big factor, 17% short interest. So is this big enough to cause a short squeeze? There's potential here for this to be a short squeeze to the upside. Company is pretty big, market cap of $3 billion. We've got lots of volume, 15 million shares. And today we're down, 2%. I think that the way to play these types of positions, especially on such a small stock, is to just play the very simplistic options. So if we were to look at the straddle view here and go out to August 15th, the stock is 1878. So if we were to agree to buy this for $18 on the puts, by selling a short put, we can collect $2.85. That's crazy. Now, a 12% return would be 18 cents a month. So this stock is trading, or this position is trading at 285. Let's just run that on the calculator to see what the percentage is. So if I collect $285 and we divide that by an $1,800 purchase price, that's the most amount of money that I would have to purchase it for. I would collect the 285, so it's actually less than that. So let's just erase all that. Let's clear this off. 285. Let's go 1800 minus 285. This is going to be what my break even is. This is the minimum amount of investment I have to make, 1555. And if we divide that 285 by 1515, boy, I'm not working today. Let's go 285 divided by 1515. And that's an 18.8% return. 18.8% return in 1 month. Absolutely crazy premium in things like QUBT. Now, how do we set that up? Let's take a look at our brokerage platform. I'm looking at IBKR, but you guys can look at whatever brokerage you're using. And do I have QUBT on here? No, I don't. So let me add it to the watch list. I'm just going to enter a new line here. Insert a row, and we're going to say QUBT. It's going to pop up, quantum computing. I'm going to add that. So 1879. And if I look at the strategy builder, let's just go out here. We were looking at August 18th, right? Or August 15th. At 275, it's wild. So you're going to see exactly how this kind of charts out, like what the profit profile looks like. And we can see that performance graph. So it's a 70% probability of profit right out of the gate, which is awesome. Now, if we make this move a little bit better, what happens if the stock moves 30% to the upside? Well, I make 18% return on my money. $275, 1515 risk. You can see that. This is why we use our brokerage. It calculates this stuff very, very fast. Max return 275, max loss 1515. There's a potential we could even get filled for greater than that. Maybe we even get like 280 on this. So the max loss or the max profit could be even better. So 70% chance of making some money. And then the break even is going to be if the stock trades at 1522. So let's mark that on the chart. We'll take a look at the chart here, and QUBT, that's the options. Let's look at the actual stock here, and 1522. 1522. So there's the line right there. And we see that expected cone. Now, could the stock drop back down to $5? Absolutely it could. I mean, it was trading there in April. So this is not without its risk. But there's potential of making a ton of money here. So it's an interesting play. If we wanted a little more safety, what could we do? Well, there's tons of premium even at these lower levels. So if I wanted to be really, really safe, I could collect $45 to sell the 12 put. This puts me on the line for $1,200 minus 45, so about $1,145. And now if we had that 30% move up or down, you would still make a $45 return on a $1,150 investment. This is what is that in a return on capital standpoint? Like 3% in a month. 88% chance of making 3%, and that break even going to be around 1150. So we would go back to our chart and we would move that down and say that break even way down here. Now they'll have earnings coming out at some point in here. So we'll, you know, we have to be at a level that we're comfortable with. And this is how I like to set up things. I think that this is an easy way to play this. The other thing that we can do, because we're collecting so much money, is there is potential to build traps with a stock like this. So what I might do is say, okay, what if I play something aggressively enough that I'm collecting $1, but I use some of that money to buy a trap? And in this case, I'm still getting $45, but what happens to my profit profile? I end up with this scenario where if the stock goes up, I make $45 return. If the stock goes down, I have the potential to make a $145 return. So I have a trap set between $14 and $15. And I do that by purchasing a bearish debit put spread, buying the 16 put and selling the 15 put against selling my 14 put. If the stock doesn't go down into that trap, it all just expires worthless and I get to keep whatever money I collected to start the trade. So in this case, it'd be about $45 minus some commissions, about $40 total. My risk is $1,248 total. I have the potential also of making some extra money if on August 15th it was trading down in this lower level. How does that look? I hope. John Blake joining early. Thanks, John, for joining me. Always good to see you. Happy Tuesday as well. Appreciate you guys joining. And thank you for the likes. I hope that was informative. Throw out some other symbols. Let me know what you want to see. We will talk about some other tickers. I've got both. Let's actually, before we move on, as you guys are typing that, I'm also going to type in QUBT over on Investing Pro, and we'll take a look there just to see what the fair value is. I'm really enjoying using Investing Pro because here's a great example of what I'm looking at. Like, uncertainty is very high with this company. Fair value, $9.56. Currently $18.73. That's a 49% potential downside. So it's interesting how different types of analysts or analytics can come up with very, very different positions. So we've got, very bullish sentiment here in general. And then we have, let me turn off my phone, because otherwise that's going to keep beeping at us. We've got very bullish sentiment here, but that fair value marking at 956. So the potential of the stock dropping way down. Makes me wonder, what if the stock, we wanted a bearish sentiment? What could we do? Is there something that we might be able to do? Well, yeah, I mean, we could just buy a put. Buying a put is pretty awesome. It's like, if the stock goes up, the return, the max loss is whatever I pay for the put. So in this case, I have a max loss of $110. But I have the maximum return of up to $1,282. Now the stock would have to go to zero. So I don't expect to ever make that kind of, 12 times my money on a stock like that. But even if we saw some sort of drawdown, this could make money very, very easily. If we look at the chart, say the stock dropped down to $14.50, this trade would make $111. We can see that right here. That's hit today. So for a $110 bet, you could double our money if we thought that the stock was going to drop. Now, one thing to note with puts in general is there's only an 18% probability of profit. And there's this huge zone from 14 all the way up. As long as the stock stays above $14, I lose my $110 at expiration. So we have to play these with caution. Now, can we set up something cheaper? Yeah, potentially. We could buy a little put spread. These aren't very expensive. And this gives us that bullish potential, has a higher probability of profit, and we still have the potential of doubling our money. Max loss $50, max return 50, break even 15.50. So if I thought that this stock was going to trade down below 15.50, then that is where I could grab this 15.50. So here we are above this, and this is the expected cone, right? So we see this blue cone is representing where the expected move is based on IV. But if I thought it was going to go down, that is a very simplistic trade to make. Just buying a debit spread, a bearish put debit spread, and buying, the 16, buying the 15. And we can do any of those things. We can, can I move this up and down? You know, I can do the 13.14. This costs costs $40, has the potential of making $59. We can go right at the money with these. So that didn't work. Let me, I was trying to grab them both, but here we go. Here's a little trade. This costs a little bit more money. You know, this is way higher probability of profit. But if I want to bearish sentiment, this is how I do it, is I add spreads. Okay, let me know what other stocks you want me to look at. We'll take a look, and I'll pull up the options chain. We'll take a look at potential plays with options, because that's what we do here. It's Tuesday. I'll give you guys a minute, and for those of you who aren't going to comment, please at least hit that like button. It really helps me. And if you're not already in the Discord chat, head over to patreon.com/drawbridgefinance. You can join for free, and that will get you over. You can join the Discord chat. You can get in there. The links are there, and you can see the trade posts after. You can see like my trophy room where I post my wins, and it's been a pretty fantastic year. I was just doing a little bit of comparison earlier today, and let me just pull it up with comparing with some of my local friends, and we were doing some, you know, what kind of returns did we get this month? What were we looking at? And you know, here's this was my Drawbridge portfolio. I don't know if you guys can see that here. Let me see if I can focus that. Got to cover my face, but there's this month 9.65% return. So that's my options portfolio. And then if we look at my RSP, which is very, very minimal trading, I do monthly alerts. Today I put them out. So for everybody that is watching, there's the performance in the RSP this month, 9.96%. This is, both those accounts are double what the S&P 500 did. In June, the S&P 500 only did 4.5%. So you know, I've got two different kind of mindsets that I like to play. I have an account where I barely touch anything. It's like I have long stock positions. I sell some covered calls against those. It's very, very simplistic trading. I look at that account really just once a week, and I'm like, okay, put on some things. Once a month, I do buy. So on the first of the month, I am buying stocks that I think are going to excel, and then I am selling off stocks that I think are not. That's a 25 stock portfolio. It's very simplistic. It's like 1 day of trading a month. The returns from my picks from last month were over 10%. So that portion of that portfolio in a single, like 15 minutes of trading, just clicking buy and sell the 15 stocks, that is made a 10% return this month. Like, you can't get any simpler than that. So for those of you who are thinking that it's really difficult to make that kind of money, it is not in the long term. What we need is very, very good research, very good algorithms, and we need to know what is going on with the market and get in the right position so that we can outperform over the long term. And that's one of the things that I offer. Then my options portfolio is a lot more active. I try to spend between 30 and 60 minutes per day working on that. So when I'm looking at those positions, how am I making money off of that? Well, I am making money off of being a little bit tweaky about the positions. You know, I'm buying positions that are maybe 45 days out. Some of them are slightly shorter, some of them are slightly longer, letting those trades play, rolling parts of the position and continuing on. And I have all of my alerts on Discord. So if you're interested in checking that out, please do so. We've got Andrew asking about Mara covered calls and for the July 3rd, 6th. And Mara has been an absolute killer. I'm prepping a video right now on how great Mara has been as a trade for me. Talk about simple. Like, I have one complex position in Mara. It's rather straightforward, but for the stock that over the last couple of years has been all over the place, what was this, 2 years ago? What are we looking at? Over the last couple of years. So if we go back, Mara, July of 2024, this is a stock that pays no dividend. So the only way to make money as a shareholder is to buy it at a low level and sell it at a higher level. Or we can apply strategies like covered calls where we can create an income stream, potential income stream off of the call values. And with a stock like this, it has these wild swings. It chases Bitcoin. So as Bitcoin goes up, the stock went from $15 to $30. Now, if you had immaculate timing and you had purchased down here at 15 and then you had gotten out at 30, you did really well. But a lot of people are greedy and they actually don't exit the trades and they try to stay in too long. And if you had purchased at $20 or $15 or even $10, what is your profit right now when you're sitting at 15.88, which is right near the average price? If we look at these long-term averages, this is the 200-day moving average. It's still below it. It's kind of crazy to think that that's what's happening. My positions in Mara that were entered at different times over the course of the last couple of years, buying high and buying low over the course of time, are averaging almost a 40% annual return. Applying only a strategy of buying a stock, selling either weekly, bi-weekly, or monthly covered calls against it. It's very, very straightforward. So Andrew's asking about the Mara 15 July 3rd calls. And what I like to do with these positions is I like to look at what my extrinsic value is. So that's how we're going to analyze this right now. Of course, I don't freeze up there for a little second. Let's just refresh that, see if we can get that going. So July 3rd Mara call, stock is trading at 15.92, which means if I have a cover call in play right now, my position is going to be worth around $1,500 already. There's only a couple days left. This expires on Thursday and that's not loading. So we're just going to jump over to something else so we can look at the price. So we're going to look at Marathon Holdings, Mara Holdings, 1591. We're looking at the options change July 3rd. We're looking at the calls. The strike right here, the 15 strike is the one we're going to look at. So what is the price right now? Well, it's 98 cents. 98 cents. And the stock is trading at 15.91. So there's about 8 cents in extrinsic value to hold this to expiration, which is not a huge amount of return. So if I was to buy this out right now or let the shares get called away from me, I would get $1,500 back. The cool thing about covered calls on a company like Mara that has so much upward potential is that if I look at the next week, now we're going to look at the July 11th contracts, the 15 calls, if we look at those, they're worth $1.15. So it doesn't seem like a lot, but it's 17 cents difference. And 17 cents in a week, let's get out our trusty calculator and take a look at what that means from a $1,500 investment. If I was to make $17 every single week, and we divide that by, actually, let's do the exact number of days because we're not at the very end of the week, are we? So this one is July 11th is currently 10 days away, and July 3rd is, no, it's still a week. It's a week difference. Between July 3rd, no, it's 8 days. Sorry, 8 days because of the holiday. So $17 divided by 8. So from an annualized perspective, if I was to make $17 every single week off of a $1,500 investment, I would make $2.12 every single day. We times that by 365 and we get our total return, $775. Well, $775 divided by 1,500, which is what it's worth right now. And we're always basing on what it's worth now. I'm not worried about what it was worth in the past. I don't care if the stock was worth $10 when I bought it or $29 when I bought it. It's worth $1,500 right now. That's what the position's worth. And $775 based on a $1,500 investment is a 51% annualized return if I was to make $17 every single week. And so that math shows me why I like to do this. And it's the same with companies like SoFi. It's, some of these companies that we look at, they're very, very low risk trades and they can make a huge amount of money. Imagine making $775 off of one lot of Mara that you purchased today. It is an incredibly large amount of money. I'm going to load up SoFi here and we're going to see what the value is. Now, the interesting thing about Mara is that the quant rating says it's a hold. It's not even like expected to go up. We don't even think it's going to go up. This year, the stock has lost 29%. Now, depending on at what point you bought it, You know, if you paid 25 bucks or if you paid $10, which you could have, you might be up or down on the stock. But that 775 every single year, that adds up. You know, imagine if you could just take that, make a 50% return, even if you had $10,000. And to put it in perspective, I don't do this with everything. Let's talk about sizing for a second. Let's just say I have a $500,000 account, so $500,000 account, and I decide that I'm going to allocate just 1% to Mara, so 1% of the account. That's a $5,000 position. That $5,000 position is now going to generate 50% return on capital from cash flow perspective. So it makes $2,550 a year. If I take that return and I divide it by the $500,000 account, like I have almost no risk on. It's making 0.5% return, just that one trade. So that's the kind of thing that when we're talking about, you know, how big we might size something, you know, having 5% allocation or 1% allocation or 2% allocation. If somebody did a 5% allocation to this would be 5 times more. So it'd be a 2.5% return. That is having $25,000 invested in Mara and $475,000 sitting in cash, and we still make a 2.5% return. It's wild when we aim for these high returns. So Andrew, I'm not really sure what we're looking at, what you're thinking. My thought is, with it being near the point of control, what I want to do is I want to just continue to roll out in time. So when I look at those positions and I look at, let's load up Mara again here and just talk about what we could do. It's trading at 16 bucks. If I buy this out and I go out to July 11th, I can pay a little bit to go up to the 550. This cost me $10 with an increased risk of 10 bucks to make 50. So that's a $40 potential increase if it stays above 15.50. Now I don't have to pay anything if I go out to a later date. But if I go to July 18th, it should be a small credit. Oh, no, it's not. In this case, we're still a small debit. And but the further I go out, the smaller this debit should get. Interesting. Not a lot of volume here, obviously. So we're seeing wide bid-ask spread. Oh, they're tight spreads. It's weird. August 1st, let's look at that. Here we go. Now we get a credit. So there'll be earnings or something in here. Something that is some catalyst. But now I'm getting paid. I'm getting paid 50 bucks to agree to sell my shares for 50 bucks more. Wild. And it's why I trade some of these things. Now I can increase this. I could probably get a credit to roll up to the 16. In this case, I'm getting 10 cents and I'm rolling my strike from 15 to 16. And if I thought the stock was going to go way up, say I wanted to get out to the 17, wanted to give myself another $1 of potential. Well, now it's only costing me 15 bucks to give myself another $200 in potential. So for $15, I add $185 in potential. That's what the break even does on that. So hopefully that helps. What else would you guys want to look at? What tickers are you looking at? And I did have SoFi pulled up, so I do want to look at that as well, because I think SoFi is such an interesting stock. Although it is at a high valuation right now, this is where what I might do is I might be really looking to say, you know, what if I sell the 15s, but I use that credit to buy a trap? You know, I can get this for a small credit. I have a potential of making 50 bucks, but 96% probability of profit, $1,400 at risk. Max return is $50. But if the stock goes up, I collect enough credit to cover my commissions. So these types of trades are like virtually free to the upside, no risk at all. And if I wanted to add a little bit of risk, I could. You know, if I thought that SoFi is probably not going to push very much higher, well, that's when I spend a little bit of money and I put on a position that has, you know, a profit profile that has a 10 to the bottom. My break even's between 14 and 19. That's a $5 spread on a $17 stock. It's pretty wild. Now I'm only going to make, in this case, it's only about 20 bucks, but still from a return on capital perspective, if I make 20 in this range, between 16 and 19. That return on capital, if we pull up that calculator again and we take a look at it, where's that calculator? Let's say I make $20 and we're risking 14.31, right? So 14.31, 1.5%, 1.3% return. This is July 18th. This is like 18 days. That's 2.5% a month, or almost 30% annualized. And that's in this zone. That's a 30% annualized return with the potential of making a huge amount if it drops down, and having that super low break even on the downside, having neutral deltas. You know, if we look at this, the delta is neutral. It's just slightly negative, 0.8%. Theta decay is positive $1.30 a day. Trade isn't making a ton of money. We can also just play strangles on this. You know, nothing wrong with this. $14 wide strangle collects $40. You have a $40 return. Now the max loss is infinite on this side. And if you're worried about that, just buy a long call to cap the upside. What that'll do is I'll create a trade called a lizard. We all should recognize this. This isn't a jade lizard. This is just a regular lizard, but the move isn't big enough here. Let me move out. We need a 60% move to trigger that upside cap. But now we've got a max loss to the downside, 15.65. We have a slightly positive delta. Theta decay is $2.10 a day. And we have the potential of making $30. 75% probability that it's going to land in that trade. If it goes down, I'm basically buying stock at 15.68. I'm totally happy doing that. If it goes up, I have a break even at 20.32. So depending on what would happen, you have to look for earnings and things like that. So if we were to go over to, usually I look at, if we look at SoFi Technologies, if we look at the earnings, we'll see when the announcement date is going to be. It isn't even set yet. So we saw earnings April 29th, so April, May, June. So we're getting close, but the announcement date hasn't come out. Jim is asking, is there a way to get out of a SoFi strangle? Expiries July 3rd, 15.50, 12.50. The call is going bad. Strangle. It's funny, you wrote strange. I read it as strangle. I'm so used to seeing that word. So we are getting pretty close to expiration on that. So there's probably not a lot of extrinsic value in it, but let's just take a look at what the position is. What can we do? And that is one of the reasons why I companies like this, there's always the value, potential squeeze to the upside. And when we look at the dotted line on here, it really shows what's happening. So if this trade was to kind of go, if it was going up, it goes up a little bit slower. We lose a little less on the upside move, but strangles do have that unfortunate valuation where they can lose on both sides. So let's take a look at the 12.50. I mean, obviously there's no risk on the put right now. It's only worth a penny. The interesting thing about this is if I was ever in a situation like this, say I had a short put and I wanted to exit it to free up that capital, because this has a margin impact. You can see that right now. Even if I buy that, there's like a 99% probability of profit on this trade. It's going to pop up here and populate in a second, but the probability of profit's around 99%, and there's margin here. If I wanted to close this, I actually rarely close short puts that are into this zone. What I do instead is I buy a put. So if I can buy this 14.50 put for a penny, what that does is it creates a potential for me to make $200. And there's virtually no cost to it. It's the same cost as closing the short put. So as these get closer to expiration, once they're worth nothing, I know most people just close them, but I usually buy a put that is a lower strike once it's kind of hit that max profit, and I convert it into something that has this potential. Like this is talking about lotto ticket play. It cost me $1 to make 200 if the stock was to just go crashing down if something happened. So those lotto ticket plays, they almost never pay out, but it's one of the little conversions I like to do. But that's not the position we're in. So let's just say I was short the 12.50 and short the 15.50 call. So if this was the position that I'm in, if we look at the profit profile right now, this is what's the most important thing. What is the probability of making money at this point in time? Well, the stock is trading at 1773. So right now it is sitting at that crux. If the stock goes up, I lose money. If the stock goes down, I make money. I have the potential of making back up to $220 from today. So that is if I thought it was going to go down. But all of these things, like this is a 2 delta. So we're 2%, 0.17% chance that we're going to trade under 1550. It's pretty unlikely at this point. There's no extrinsic value in here. So the first thing I would do is, if I was in this position, is I would look to close the 1250 put. And again, instead of doing that, I would just buy the 1450. This creates a spread. So that's component one. The second thing I have to do is I have to close this 1550 call. I have to get out of that because I have it open and it's costing me money. So I have to look at the chart and make a decision. Where is the best new position? If I look at, so if I dailies, maybe I think it's going back to 15 and or 1550. I mean, it easily can pull back to that level. So if it did, what I might do is just roll that out. I might not panic about this at all. I might go out to July 18th and say, is this enough time to get me some extrinsic value to give myself a little bit of a break even? We can look at the put side. This 1550 put is worth 13 cents. So that's how much extrinsic value there is because it's out of the money, which means I'm going to also be getting that extrinsic value to sell the 1550 call. So I'm going to be purchasing back the July 3rd and then selling the 1550 at a later date. Now, this is people don't like to do this. You know, they think this is a bad move, but I have found quite a lot of success in this type of move. I look at this and I say, okay, the delta is 87%. So it means it's an 87% chance that it's going to be above 1550. Well, I want to take on some risks so I can get paid. I might consider rolling out to a higher call. What this does is it actually creates a debit situation. When I look at this, I'm paying money. I'm paying 36 cents to do this. But by doing that, I'm putting myself in a slightly different scenario because I have to think about what I'm rolling into. So now let's take a look at what the chances are. I'm going to clear everything off and we're going to look at what if I rolled into the July 18, 1550, what does that profit profile look like? I have the chance of making $238, but only if the stock is under $15.50. If I instead, and probability of profit 53%, so 53% chance of making money. If I instead sell the 16, I have a similar probability of profit. No, this is 53%. My break even is 1791 compared to my break even of 1788. So these are virtually the same. So this may not be right. There's not enough extrinsic value to warrant taking on this additional risk. You know, for the 6 cents difference that I'm getting, I'm looking at the 1550 put and the 16 put and saying, you know, how much difference is there? I'm capping that potential recovery by a substantial amount because now I only have a max profit of 191. But as I get closer to this, I have greater and greater potential of making money. This probability of profit is now 59%. Now my max return is only 120, which still may put me at a loss on this trade, but the break even is now 1820. So this means that even if the stock was to go up from here, I would theoretically be making money. I would be putting myself in a positive theta position. And I like these. I like to do this. I like to chase these around a little bit. I can also sell the put on the other side. So I can sell the 1550 put, get a little more credit for this. And I know that this is a net debit to do that. If I'm paying, what was I going to pay? Can't remember what the total was. Oh, now I've jumped all over the place. That's not what I was trying to do. The other option is to just roll it out as a straddle. And that is to roll the put up to collect that other 13 cents and then have both of them at the same price. And we have a greater probability We can see the break evens if the stock is between 14 and 18. We're essentially putting on a new trade. We're closing the trade that was a loser and we're putting on another trade, and we're basing it on where the stock currently is. So this one, the break even will be between 13 and 18 effectively. So we'll go back here and we put those, we mark those on here and we say, well, I think the stock is overbought and it's going to come down. And I think it's when it comes down, it's going to go somewhere in that range between 18 and 13. That's what I want to do. So I'm putting on a new optimized trade. I can track it related to my old trade, or I can record the old trade as a loss and just put on my new trade, depending on what I want to do. Or I could just not play the short put at all. That way, if it pulls back, I can put the short put on at a later date. Maybe it's not worth the only 13 bucks I'm collecting. So hopefully that helps, Jim. Does that make sense? Let me know in the chat if that makes sense. But effectively, I would take off a trade. That's what I would do. I would take off the losing trade, and I would put on a new trade that has a higher probability of outcome, regardless of what happened with the first one. We have to follow that chart, though. That's one of the issues with being a long-term trader. If we want a wider swath, we put on cast a bigger net. June 10th, you put that on, so you're in it for 21 days. Remember, we know that as we get closer to expiration, the extrinsic value is less in those time frames. If we were to look at like a profit chart, boy, could I pull one up? Yeah, so we'll pull one up. I think it's important to understand this because a lot of people look at, I'm just pulling up a theta decay chart here. Where's my theta decay chart? Theta premium decay. Let's just look at this. You guys can take a look. This is a premium theta decay graph. And we have to understand that what we're looking at, most people chart theta decay and they chart the at the money. Decay of at the money premium. But when we look at this, at the money decays faster from 30 days to expiration than out of the money does. And this is one of the things that if you watch Tasty Live, they really try to educate people and say, focus on this portion of the trade where, we're getting no decay up here, 120-day trades. Like this is what Tom King does. He does like those 120-day trades. I don't like them. They're just way too long. You're betting on something that's going to happen way too far in the future. At 90 days, you're starting to get some decent decay. But this section right here, in that like 60 to 30 days, is where we have a consistent slope. And when I say slope, let me just change the color here. We're looking at the angle of the decay. Now, if you're going to trade, at the money options and in this last zone, like the 21 days and less, at the money has lots of decay. Out of the money doesn't so much. So especially when we're getting close to expiration, like what's going to happen with this current position? If we go back to the SoFi, and I'm not by any means am I saying that you're doing something incorrect. I'm just trying to show that the amount of money that we can make in this last little while, like in these next 3 days, is so insignificant. And you'll see here, you'll have like a max return of $2 from an extrinsic value point of view. If the stock doesn't move at all, you basically are break even. We're sitting right here. This has become a directional trade and is no longer generating extrinsic value because the extrinsic value is right here. It's a buck and it's a buck. It's not even. It's like $1.50. It's like non-existent values. We're not getting paid anything. If I was to put this same trade on for August, that same trade, I can't really do it, but let's say I do the 12 and the 15, which is similar. Now if I look at the theta decay, and I look at the 1770 level, which is right here, this trade makes 65 bucks. There's a significant amount of extrinsic value in this trade. And when we relate that to this chart, we're seeing that. We're seeing these are both out of the money. Remember where we're looking. We're looking at the 80 delta, and we're looking at the 5 delta. So these are not at the money. At the money is a 50 delta. That would be the 18 strikes. These are significant. They're 20% away. What we're doing is we're comparing where we are. Well, where I want to be is on this part of the slope. That's why August is paying more. But these last 3 days in July are not paying very much down here because the slope is too shallow. If these were the 18s, it wouldn't matter. I mean, I could be here. Oops. You know, if it was the 18 straddle, I could be here, or I could be making a ton of money with 3 days to go if I had the 18. This is where straddles and butterflies perform very, very well in that last little bit of expiration. But if we're going to play wide strangles, we need to concentrate on this zone. And we know that Tasty Live, they really have done tons of backtesting on this. And they tell us that the optimal range is between 45 days here and 21 days. So if you put on this trade on June 10th, you were already at the 21 day. You were putting on a trade that was already in the less than optimal zone. So it might be something to consider playing slightly longer duration and getting into a higher theta decay. So something to consider, and screenshot this if you guys are watching and you don't really understand, because most people, when they show this chart, you know, this is one of the charts that I built, but they don't show the in the money and out of the money. They only show the at the money decay, and it's incorrect. So they decay differently because there's extrinsic value difference. It's a bell curve, remember? So the further you get away, the smaller it is. Like if you're going to make only a couple little profit on a way outside wing, well, of course there can't be a ton of decay because there's very little volume to make. And at the middle, there's going to be lots of decay because the bell curve's tall. That's how bell curves work, right? Higher in the middle. Good, Jim. I'm glad that does. And you just noticed the live stream name. Yeah, the big, beautiful live stream. It is, it's crazy. We'll see what happens. I'm excited. Okay. This has been a fantastic stream. You guys are amazing. What are we trying to do? We're trying to get rich together. I hope this answers some questions. I hope this got your brain thinking about some things, because that's what we're trying to do. I'm going to see my patrons on Thursday for the members only live stream. So if you're not a member, jump over to patreon.com, sign up, and start seeing my trade alerts. You can ask these questions anytime. We can review the trades and we can start making money together. That's the goal. Let's get rich together. You guys are amazing. Thanks so much. See you next week. Take care. Bye.